equipment, okay? And we know that falls under assets. What I'm going to do is to give you what I like to call a legitimate cheat sheet that you can literally probably look at before you go to your exam, write on your paper, and it helps. But it also helps to kind of do this before we get started as well, because we have a lot of different accounts and that can feel overwhelming, but once we categorize them, remember that's all we do in accounting is categorize, it's going to make us feel a little bit better and decrease a little bit of our what we may be thinking at that time. So just kind of going back to what we've done a lot of times, assets equals liabilities plus equity. Now, after this, as we go to the fourth module, we're going to spend a lot of time over here in the fourth module. It's still going to affect some things here, but it's going to be more so the fourth module is going to talk about liabilities and equity. So pretty much right now, we're talking about is assets. Even though we're talking about property, plant, and equipment, let's just kind of put something together right fast. We have two categories of assets. What are those two major categories? One of them is current, and the other one is what? Long-term, okay? So we have current liabilities, current assets, and we have long-term assets. Okay. In our previous chapter, we looked at a current asset. I'm going to write it a little bit lower so we can put our debits and credits up there. We're not going to worry about all of them at the time, but we want to understand what's going on. One of them we have is called accounts receivables. That's what we previously did, okay? Accounts receivables. In this chapter, we're looking at property, plant, and equipment. So I'm going to put this all on one line, but this is just so we can understand where we are. Property, plant, and equipment, which can be in the form of land, buildings, abbreviate, and equipment. Now, there could be more categories, but in general, that's what we have, okay? So, as you study, remember, we're just on one side of the balance sheet. Now, I just like to say, we may buy something on credit or something, but in general, what we're talking about is this side of the balance sheet, okay? When we get to our next module, you can group those as well, but that's next time. We're just showing how we can make things a little bit more simple. And it doesn't just work in here, it works in everything. Like I say, it's just accounting, which means we do a lot of categorizing. So as you look in your other classes, categorize those as well, okay? No matter what your major is, there's always going to be some kind of overlap that goes on. Try to fit that into some category that's going to be helpful to you, okay? Now, we always have to remember how things increase. Even though we have a couple different categories and a bunch of mini categories, if you look at it, everything is going to increase the same because we have assets. Okay, so all of my assets increase with a debit. We agree? All right. All of my anything at all that decreases this major category is going to go on the credit side. That's anything that decreases, okay? Now, I'm putting my greens for increases, my reds for decreases. I'm doing it because, along with these accounts, we have identified two what we call contra asset account. Contra means against, and so whatever you put after it is against whatever it is. A contra asset account goes against assets, means it's going to decrease the asset. That first contra account would be what we talked about in the last one, allowance. The allowance for doubtful accounts. And here, with our long-term assets, we have what is called accumulated depreciation. Now, do these increase or decrease assets? Do they increase assets? Do they decrease assets? Good, okay? Now, we're going to take this a little bit differently because I'm going to write it a certain way to understand what goes on. It is true. This allowance account and this accumulated depreciation, they decrease assets. So, I'm going to start off by putting a minus sign here. They decrease assets. They decrease assets. Now, understand that in order to increase the actual account, in order to increase the actual red account, which represents the country account, then we would probably put a plus sign right here to show that it increases the account, okay? So how do I increase my allowance? By crediting it. But understand that crediting this also decreases assets, okay? So I'm going to leave it there today. We're going to do a little bit different, but I think if we look at this, we'll understand that anything increases this side right here is going to be done through a credit, but it also has an impact in that it decreases our assets, okay? So this account is going to decrease assets, and this account is going to do the same thing, okay? So that's just kind of showing us where we are. So all I have to do now, since I know all of these accounts, I just think about every new account that I have. I put it under here. It's going to either fall under one of my regular accounts, or it's going to fall under one of these allowance accounts. Fortunately, we only have 2 allowance accounts, okay? Now, as I said earlier, there are going to be some small things that we have, like when we're talking about accumulated depreciation, we also have depreciation expense. But we've dealt with expenses a lot of different times, okay? So depreciation expense is going to fall under my equity account, and I increase the depreciation expense, meaning salaries for this month. I add them together over the year with a debit, but it has a negative effect on equity, meaning it's going to lower equity because equity increases pot with a credit and it decreases with a debit. Okay, so any new account that we have here is going to go in this place right here. Depreciation expense, the one that's related to this one, is called bad debt what? Expense. Bad debt expense. And hopefully we don't have any. Obviously we're going to have it. We have to remember that. So as I see an increase in my bad debt expense, I debit it because it's showing an increase in my bad debt expense. But what is the effect on equity? It's going to decrease my equity, okay? So for our exam, we're concerned about how we debit and credit. But for your future life, when you're talking about you're going to be over someone, you want to know how it's going to impact your assets, liability, and equity. Okay? So for our exam purposes, this is probably going to be more important. But we don't want to just focus on the exam because we don't want to just come and forget this stuff. We want to be able to use it to help us make money in the future. And we do that by being able to communicate with those that have a lot of money, that's the bank or our supervisors who can approve us. And the more we can put it in this terminology right here, the greater our chances are going to be. It doesn't guarantee it, but the greater our chances will be that we can probably get it compared to someone who hasn't done it, okay? Any questions on that right there? Can I erase it? Is it okay to erase it? Okay. And it's a little bit difficult to see. The light's a little bit dimmer today. All right. We're going to look at a couple of different exercises here today. And this is where I want to start. I want to start with give me just a second to pull up there. I want to start with a depreciation exercise, okay? The first one we want to do is a depreciation exercise, and the one that we will do is it is a similar homework one, but I don't have the actual homework because it's not in this module here. So we're going to do a general one that's going to help us with depreciation, okay? So with depreciation, and I wrote it out, but it can apply to any of them. I think someone had a depreciation question the other day. It's going to look just like that because with a lot of this stuff, all we can do is ask questions one or two ways, okay? And it's not a lot of fluctuation. No matter who teaches the class, you can only ask these in one or two ways, okay? So the thing about depreciation, I'm going to come back to this, but right now we're going to think about depreciation. Depreciation is not relative to value, okay? Now, I talked about that last time, and I told us that we were going to use the word value for what we were doing. Then I also said that we're going to come back and establish today that it is not talking about value, okay? Depreciation is simply an allocation method. What does an allocation method mean? That means, think of it like this. If you can buy a car that you're going to, a truck for your job, whatever, that you're going to use for the next 5 years, what if you can buy, quote unquote, what if you can buy enough of that truck the first year to use it, then buy some more of that truck to use it next year, and just buy enough of it to use as you need it each year? Now, I know you can't buy enough of a truck. You're either going to buy a whole one or nothing at all. But you understand what I mean by buy enough of it? You know, if I could just pay for that truck as I go, obviously do it with payments, but if I could do it as I go and buy a piece of that truck every time I need it, then that's going to help make us allocate it, okay? So let's think of it this way. Last time my truck was $40,000, I'm still going to buy that $40,000 truck, but we're going to use $50,000 a day just for ease of understanding, okay? So today we're going to say we have a truck for our business. This has nothing to do with the assets at this point in time. We're going to come back up there, but this is just a separate example. We're going to buy a truck for $50,000 today, okay? And to really make this point drive home, we're going to pay for it all at one time. We're going to pay for it with cash, okay? So we buy that truck today for $50,000. We're going to use that truck for 1 year, 2 years, 3 years, 4 years, and 5 years, okay? We're going to use it for 5 years. Now, when you buy the truck, we remember that we're going to always, and I'm going to erase this, but we're going to always debit property, plant, and equipment, which will be the truck, for $50,000. And then let's say we pay cash, we will credit $50,000 cash, okay? So our journal entry would be that right there. I'm going to erase this, but the reason I wrote it up there is because I want to say if we buy this for cash, then these are all associated with assets, okay? This is all associated with assets. That'll be debiting property, plant, equipment, truck, and crediting cash, okay? Now, these are both asset accounts. This has no impact, none at all, on the income statement at this point, because my journal entry is just consisting of entries and assets, okay? But I need to be able to record a part of this in my income statement. Why? Because my truck is used for operating things. It's used to carry stuff all around here, whether it's to you who needs it for your job or for another person that's going to sell it. My job is to get you stuff. So this truck will be using my regular operating expenses. If you remember in chapter 5, we looked at, we went from revenues and expenses to revenues from operations and expenses for operations. Then we had a line that was below that said other revenues or other expenses. This is not other revenues or other expenses. This is an expense that's related to driving this truck every day to produce the money that I do in my business. So because of that, we want to allocate some of this cost to our income statement. And we do that by simply 1, 2, 3, 4, and 5. I want to get my truck in my income statement. These years are going to be years that I depreciate. To say it differently, to allocate it. So let's just say that at the end of 5 years, it's not true that it's going to break, but for this purpose here, let's say it's going to break and be of no use to us. And there are some jobs like that where you have to buy a truck literally every 3 years, every 5 years, because they want you to have the most up-to-date model to make sure that you can get where you're going. So in this case, this truck will be useless to our business at the end of 5 years, okay? So since I know I'm going to use it for 5 years, I'm going to take this right here and divide it by 5 years, and that's going to give me $10,000. Now, what does this $10,000 mean? Remember, my truck is only going to be good for business for 5 years. I can drive it personally, once that's over with. But for business, it's going to be good for 5 years. So remember I said if I could buy enough of this truck to use it in 1 year, 2 year, 3 year, 4 year, 5th year, well, I'm going to do that on my income statement here by depreciating it. So for the first year, I drove that truck and I used it, and I have $10,000 that's going to go in my income statement. So revenues minus $10,000 is going to be some income that I have. This is going to be one of my expenses, okay? This is going to be called depreciation expense. Think about what we had a second ago. The next year, how much will go here in my depreciation? Or to think about it in the way we're saying, in my allocation, how much of this $50,000 am I going to allocate to year 2? It's another 10,000, right? Because I only have it for 5 years. I bought enough of this truck in 10,000, and so this is going to go to depreciation expense. Depreciation simply says I allocate the cost of this over the time period that I use. This is called straight line depreciation. There are other ways, but this is called straight line depreciation. It's generally the easiest to help us wrap our heads around, which that's why this is the only one we're doing. Okay. Year 4, I didn't do 3, but I already know in year 4 I'm gonna have how much there? 10,000. You see what I'm saying? When you use straight line depreciation, you don't really have to go in order to know how much you're going to have. Okay? I know because you got this right, then I know that you know we have 10,000 here and we have 10,000 here as well. So what I'm doing with this truck, I am depreciating this truck. How am I depreciating this truck? I'm depreciating this truck over 5 years. To say it differently, I'm allocating the cost of this truck over 5 years. So depreciation equals allocation. Allocation to what? My income statement. I'm allocated to my income statement. Every year I do it, I'm going to put this in my income statement using the account called depreciation expense. Okay? I'm going to debit depreciation expense to increase it every year. We good so far? Okay. Every year. Now think about what we just said. I gave you year 1. You gave me year 2. I gave you year 2, and then you gave me year 4 all by yourself, right? You already knew that. What does that show us? That shows that each year depreciation expense is only going to be a number by itself. That in some ways for a straight line depreciation, that's predetermined, okay? What's the other count that goes with that? The journal entry would be to debit depreciation expense but we also have to credit something, right? We'd have to credit accumulated depreciation. Now, what does that tell you? If you can just flat out say that you know $10,000 here without doing anything else, then you know this is a standalone number. But what is accumulated depreciation? Number one, it's an asset type of account, right? But it accumulates everything that has been done up to that point. So after year 2, my depreciation expense will be how much? We already talked about that. How much is my depreciation expense? 10,000. But my accumulated depreciation would be how much? Say again? 20,000, because I accumulate what I've had over time, okay? In year 4, you already told me you're going to have 10,000, but my accumulated depreciation as of that point in time would be how much? 40,000, okay? Is everything okay so far?
So the depreciation expense is the year on its own versus the accumulated is the year you're on plus the years prior.
Sound like the textbook. That's exactly right. She said the depreciation expense is a year on its own, but accumulated depreciation is all the years prior. Is that how you said it? That was an excellent summary of what you heard. Okay? Which makes our journal entries pretty easy, fairly easy, okay? Now, I'm going to erase this small thing right here. Don't forget what she just said, because that's very important. Every year, actually it's probably more like monthly, but we're thinking in terms of year now. Let me say every single year, because that way we won't miss one. Every single year, my entry will be a debit to depreciation expense, and a credit to accumulated depreciation for $10,000. Every single year, this is what my journal entry will be, okay? Now, how does that relate to what she just told us? Depreciation expense is for every single year on its own, okay? The journal entry is for every single year on its own as well, right? But at any point in time, when we go to our balance sheet that pretty much keeps a running total of assets and everything that affects it, we can add it up, okay, and see what it is. When I say add it up, at the end of every year, it will be current as of that year. But our expense, as we know from chapter 4, that is going to go away. It's going to zero out. It's going to close out at the end of the year, okay? So just to make sure we have it, when we buy a vehicle or we buy anything, when we talk about depreciating, we're not talking about it losing value. Because if you keep that same truck for 30 years, it may be an antique, and it is going to be it could be worth more than it ever was on a value standpoint. So we're not talking about depreciating is a loss of value. So when your car salesman tell you, you're just going to depreciate 10% and leave off the lot, tell them you don't know accounting. So why are you talking to me? Give me somebody else who's going to give me a good deal, because he's going to go in the back and mess up your numbers. And that's the person that always got to go talk to the manager. Even though he sold the same vehicle 5 times, right? So I'm just saying, understanding depreciation is not, depreciation and that discussion has nothing to do with the value, okay? Those homes in the historic district, they're worth way more than they ever were, okay? Your house where you live at 2 or 3 years ago, if you sold it, you might have gotten this. Now you can get this much more. So depreciation has nothing to do with the time that's there, okay? Depreciation is simply an allocation method over the period of time that I use something. Depreciation is only the allocation of the cost over the time that I'm going to use something. Depreciation expense is always going to be the same every year. The depreciation expense is going to be the same every year. This journal entry will be the same every year if we're using the straight line method, okay? The only thing that's going to add up over time is going to be accumulated depreciation in your balance sheet, and so that's something that you will see add up over time. So at any point in time, we already know before we get here at the end of the 5th year, we're going to have accumulated depreciation of $50,000. We know at the end of the 2nd year, it's going to be $20,000. We know that each year, you close your eyes and pick one, it's going to be $10,000. Okay? So, first of all, is everybody okay with that? Okay? So this is our journal entry. Now, if I have to make a journal entry for this here, we've already done that. Let's make sure that we understand, because I'm going to make a slight modification. So I'm going to erase a couple of things, okay? I'm going to make a slight modification. Let's say that this is still over 5 years. We good? It's still over 5 years. But instead of buying it on January 1st, we're going to buy it on July the 1st. This is a modification. We're going to buy it July the 1st. That means we have how many months left in the year? 6 months, right? We agree? That's half of the year, so we have 6 months left. If I bought something on July the 1st with 6 months left, let's think about it like this. What does depreciation do? It allocates it over the year. So if I only own it for half the year, can I allocate it for the full year? No, I can't do that, right? Because I didn't even have it. I didn't even know if I was going to get it. I had to get approved. So I don't know if I'm going to have it. So I cannot depreciate it over the full year. I cannot allocate it to the whole year. I can only allocate it for the time that I had it, which is what? A half a year. So if I buy July the 1st, can I still put $10,000 here? Remember, if I buy July the 1st, I can only allocate it over the time I have it. July, August, September, October, November, December. That's 6 months that I can allocate it over. So will I still have $10,000 here? What should this number be?
5,000.
5,000, because it's only a half of a year that I had. I bought it July the 1st, so in this case, I can only have $5,000 for this year. Okay? That's all I can allocate it under the straight line. Why? Because I only owned it for half of a year. Previously, we owned it for a whole year, okay? But this one here, we're going to own it for half a year. Make sure that's okay before we keep going. Okay. Everybody okay? All right. So now, I bought it July the 1st. I can only use half of it this year. How much depreciation expense will I be allocated for year 3? Will it be 5,000 as well? Who says it's going to be 5,000? Who says it's going to be 10,000? It's still 10,000 because I owned it that whole year, right? So I can allocate that whole year. Year 5, I'm still going to have it there, right? But I only have at this point in time $45,000. Don't you want to get credit for the other $5,000 in your income statement? So what must I do? I must institute a 6th year and have $5,000 of depreciation there as well. Okay. At the end of the 6th year, what will my accumulated depreciation be at the end of the 6th year?
Accumulated, it'll be the 50,000.
It'll be the whole $50,000. Okay. Now, why does this look different? Because in this case, I purchased it halfway through the year. Okay. If I purchased it the last month of the year, I would only put 1/12 of that there, and I'd put the other 11 months in that case. But a half year is an easy number to work with. Okay. So we understand that I want to make sure we understand a couple of concepts. Number one, as we've been saying, depreciation has nothing to do with value. It is an allocation over time for the amount of time that you own that and use it in your business, okay? That's depreciation. That's why we do use depreciation. The second thing, depreciation is only for this year. The third thing, this journal entry is going to, when I say this journal entry, this part is only going to be, we're going to use those accounts in that way every time. That's not going to change. The amount may change depending on when I bought it, right? But overall, that's going to be the same one. And number 4, I always have to make sure, which is the same as number 1, make sure I know when I bought it, because I can only start depreciating it at that time. I can only start allocating it at that time. What am I allocating? I'm allocating the usage of it. If I didn't own it beforehand, I couldn't use it in my business beforehand, so I could not allocate it. So hopefully all of those will make us understand why we're doing a depreciation in this manner. How you feel? Got a question? Okay. Question? And you may not have questions now, but just make sure that if you have them, you bring them to me, okay? Yes, ma'am.
So, like, obviously, whenever it's half of the year, you divide it by 2.
That's right.
How would you do it if, like, it was 7 months?
Let's see. What month? What? Tell me when you bought it. Tell me the date you bought it. You probably bought it August the 1st, I think.
Let's just do September.
Okay, we bought it September. If I bought something September, and what we're going to do is think about it this year. We always have 12 months in a year, right? Months in a year. So 12 months is always going to be my denominator, right? So if I bought it, if I had it for 6 months, then that 6 months would equal 1/2 a year, okay? 1/2 year. We're good with that one, right? What if I bought it in September? Then I would have it for all of September, all of October, all of November, and all of December. So my denominator will never change. The 12 months. We only have 12 months in a year, period, right? If I buy it in September, how many months have I used it in my business for? For 4 months. So I can only allocate it for 4 months of this year by simply, and I'm putting in different colors so I can show us the difference, by putting 4 over 12, which will give me 1 over 3, or 33.33% is what I have for that year. Why? Because I only use it a third of the year. If we go from January, February, March, April, and then from May, June, July, August, and then from September through December. This is 4 months, 4 months, 4 months. This is a set of 4 months that I bought in right here, which is why I use 4 over 12. This denominator never changes. It's always going to be something out of 12 months, okay? It's always going to be something out of 365 days if we were doing it on a daily basis, but we're not, okay? Does that help you out?
So you don't include the month that it actually is as a number?
Yes, you include September, October, November, and December. That'd be 4 months right here. And so 4 out of 12, it'd be all those 4 months.
Isn't July the 7th month?
July is the 7th month, but it comes after the 6th month. It's one of those things where January, February, March, April, May, and June is 6 months, right? And then when I start on July, I'm gonna use some people. July, August, September, October, November, December, those would be the 6 people the 6 month, the people that represent the 6 months there. Does that help you out there?
So if you got it on January, it'd be the full amount.
If you get it in January, it's gonna be full amount like you said, which I'm just kind of putting it here, which is 12 out of 12 months. That's right.
And then as soon as it goes on to February, that's whenever you do 1 over 12.
You will put this. You won't do your books until February, but you will do it for January. So the first month in January, you would have January, February. Depreciation expense, you would have 1 out of the 12 months there, or in this case, probably 1 out of 60, because for 5 years you have 1 out of 60 months there. You have 1 out of 60 months there, and on and on and on until the 5th year. And that last time, if you're using this one right here, that'll be the last of your 60-month allocation, because that'll be the last month you use it. They're not going to let you use this truck in your business. You have to get a new truck at this point in time. So you buy it on January 1st, you put it in use January 1st, so you can start allocating the day you put it in use. Let's say if you get like say if you do photography, right, and you get a camera. You get a camera on what's today? February the 2nd. Excuse me. April the 2nd. You bought it on April the 2nd. And you bought it today to go start taking pictures today at a wedding that's going to happen on this somewhat beautiful day, right? You can start allocating the cost on April the 2nd of this year. So if we round it off to April the 1st, that means we'll have 9 months. Okay, we have 9 months that we can do it, because we didn't own the camera in January, we didn't own it in February, we didn't own it in March. We bought it April the 2nd, which for our purposes April the 1st. And so I can start for these 9 months that are going to go on down there.
So January is going to be 12 over 12, so that's going to be 1 whole, and then February will be 11 over 12.
Under which scenario?
For the division, for you to multiply the 10,000 times 12 over 12, the 10,000 times 12 over 12 would be 10,000 times 1, versus if we started on February, we only have 11 months for now, so it's going to be 11 over 12 times 10,000.
Yes. If you start in February, that's perfect. If you start in February, let's say, well, first of all, it's getting kind of cloudy. Can I erase some of this? Is that okay to erase some of it? Okay. Sorry, it's getting a little bit cloudy there. You won't be able to see it there. I'm going to give you this one in two different ways. Let's say if I buy a camera, January 1st, I buy January 1st. I bought two cameras January 1st, right? And I use one. You start using the first one on January 1st, New Year's celebrations, right? And then I started using the second one in February. I started using the second in February. Since and the camera costs $10,000, you were just using this same amount here. Or better yet, for ease, let's use $12,000. If I have a $12,000 camera, then for the first month, I would have started using it, okay? So I would use it for 1 out of the 12 months times 12,000, which will give me $1,000 of depreciation expense for that month, okay? If I start using it in February, this is a separate one now. This is a totally separate one. I have 1 out of 12 months times 12,000 again for $1,000. That's depreciation expense. Now, I think what your question is, what about the cumulative depreciation? At the end of January, my accumulated depreciation for this one here will be $1,000, okay? $1,000. I don't own this one yet. Okay. I don't own this one in February yet, right? So I'm not gonna have anything for that, right? Nothing there because I don't own it. I don't own it. I haven't started using it. Now let's go to the end of February. At the end of February, my accumulated depreciation for camera 1 would be for January and February, so I have $2,000 associated with that, which that's 2 out of 12 months total right there. Everybody good with that one? Okay. Now, I also bought one, and I also bought one in February, and my accumulated depreciation for that one will be how much? At the end of February, I bought this one in February. I only have 1 month of depreciation, so my accumulated depreciation for this one will be how much? 1,000. Is this kind of getting to the answer there? Get to your question?
So it's just gonna be the 1 over 12 instead of 12 over 12 like I thought.
For this one here?
For January.
For January, which one? January expense or January depreciation expense or accumulated depreciation? We have this scenario, different scenarios. We're talking about accumulated depreciation over here. And so this one is the end of January for only just this camera right here. For that one in January 1st, and this one is going to go for my accumulated depreciation here.
I'm mainly trying to understand that 12 months a year that you have that on.
The 12 months a year? Okay, which part we understanding?
I'm trying to figure out what fraction is designated to what month.
It depends on when you buy it. If you buy it in January, you start 1 out of 12. 1 out of 12 every month. Every month is going to have 1 out of 12 for the depreciation expense if you bought it as in January. Every month will have 1 out of 12 for your depreciation expense, the income statement item. Accumulated depreciation is going to accumulate over time in your balance sheet. Now, for each journal entry, you're going to have a piece of accumulated depreciation that you're going to add to your balance sheet. But every month, you're going to have a 1 out of 12 journal entry. Every month is going to be 1 out of 12. Every month is always going to be, because we only have 12 months in a year, so every month would be 1 out of 12. This here represents my accumulated depreciation for all of the year. If I only bought it halfway through the year, this would be my accumulated depreciation. If I bought it in September, I only have 4 months of total accumulated depreciation. So every month I add one. If I bought it in January, at the end of January, I only have 1 out of 12. At the end of January, my accumulated depreciation will be 2 out of 12. At the end of January, my accumulated depreciation will be 3 out of 12, on up to the last month, okay, or through that last month. So 12 is always going to be here because only 12 months. It depends, one, if you're talking about accumulated depreciation versus depreciation expense. And then whether it's a particular journal entry or the whole accumulated depreciation in the balance sheet that we're trying to sum up. And that's the same concept that we can apply to the allowance account that we had as well. Everybody okay? Can I go to another subject? Not subject, another little portion right here. Make sure we cover all your homework and different things like that. All right, next we're going to use an example of land, okay? This land, if, let's say, we did a similar example with equipment and stuff the other day, but we're doing another one today that has to do with land. It's the same kind of thing in that we want to make sure we get our cost right, because our cost is going to determine how much we can allocate, depreciate over time, okay? So we're going to go through some concepts here, and they're going to be similar to what you have. Let's say you buy some real estate, right? Let's put it right here. Let's say you buy some real estate for, well, don't worry about the amounts yet, just, we want to get the concept down. So we buy some real estate, and with that real estate, we're going to have to do something to it. We're going to tear down a bunch of stuff, right? This has a cost that we'll come back to in a second. We're going to come back to the cost in a second, but we want to understand what's going on first. There's going to be a cost associated with it. Once we get that, we're going to have to tear down some stuff. Everything's not going to be in shape. Maybe an old building or something. We need to get that stuff out of the way. So we're going to have some things we probably will refer to as demolition costs, okay? Some demolition costs. Because we want to know anything you buy. You want to get that kind of stuff out of the way, okay? Now, at some point in time, either when you bought it or maybe there could have been a problem that was associated at first, you're probably going to go through some type of a closing attorney to get access to it. So you're going to have some attorney fees. That's all. When you talk to your real estate, when you're going to sign those papers, an attorney is usually involved. Okay, so there's going to be some costs associated with that. You can combine that with broker fees. That's the real estate that you got it from, the real estate person you got it from. And you know what you're going to put on it, right? We already know what we're going to put on it. And I'm running a little bit low right here, so let's use this space over here. So you're going to, you've been working on it. You've been kind of thinking about it. No one's used this place for a long time. So you have this building that you want to put in place. You got an architect to design it. So you have some architect fees. So, okay, this is some more stuff you can have. And so you also have a parking lot you're going to put on it. You're going to put a parking lot on it. You may call it a driveway. You're going to have all that, okay? So this is in general what's going to happen anytime you have something. Obviously, if you're not building something, you may not have to worry about an architect fee. Maybe some repairs that you need to consult with architect and engineer, but overall, this is what we're going to have, okay? Now, our goal is to determine to determine the cost of land. Determine the cost of land, okay? So, we're going to, let's just say we paid all of this at one time. We paid all this at one time, and we got to go back, or we're going to have somebody else go back and to put these in the right categories, okay? That's going to be the problem. We paid all this money, and that happens sometimes. You may not have had time to do that, or they may have accept one check or whatever it is. You paid all this at one time. Yeah, you've been working on that stuff for the attorney fee, but you're going to do it in conjunction with this building. So you just paid one sum and someone else distributed it, but you have to do the accounting, or your people have to do the accounting. We know how much goes to land, the building, and all this other stuff, because if not, then we won't be able to depreciate certain things. So, how much is this going to go to the land? Well, we are going to build that building on that land, right? Everybody agree? That's why we bought it. So should this cost go to land? What? Say again?
Yeah.
You would think that, and that's why we're doing it. It's actually going to go to the building that we're going to put there. Even though we have a building, even though we have land, we're going to put a building there. We would not have been able to do that if we didn't have the land, but that is its own category. If we remember, we have property, plant, and equipment, we have land, we have building, and I'm going to add another category in a second, but we have land and building. Those are the ones we work with, but I'm going to add another one in a second, okay? These are the ones we have, so this actually goes to the building one, okay? Why? Because it's associated with a building. I know that the only reason we got it for the land, but we cut one check, and then we have to go back and do it all out, do the accounting on our own, okay? So this, anytime you have architect fees or the engineering fees associated with the building, it's going to go to the actual building, okay? Now we want to understand the cost of land, but we got all this other stuff in here as well. All right. I'm going out of order so we can really start to get this. What about the attorney fees and the broker fees? That's pretty much one thing, but what about those fees? Now, we're going to have a building on there. We have a parking lot. We bought the real estate. What are these fees associated with? What are these fees associated with? Are they associated with the building, which by the way, that we don't have yet? Are they associated with the building? No, it's only associated with the land. So we can include these in here, okay? Attorney fees and broker fees, this is going to go here $1,900 and $5,200. The broker is that person, we think of them as a real estate person, or that's what we think of them as, or the real estate agent or whatever. That's the broker, okay? The attorney's fees are usually when you go to the closing, and sometimes they may all do the same thing, but they're more than likely going to be two different sets of people, okay? This here goes to the cost of land. Now, what about the actual land and real estate itself? Where does that go to? Does that go to land or building? You got to go to land, right? That's the easy one, so we're going to always get that one, okay? But I'm kind of going out of order because you don't know which way they would possibly appear, okay? They can be given to you in any list. I just wrote them the way that I wrote them here, okay? What about, picture this right here. We bought this land, and we had all this stuff on this land. We're going to build this building, okay? Raising Cane's. I don't know that we are business, whatever, but they're not there anymore, right? In order to, somebody else is going to come in a restaurant. Did you know that? Guess what they said? They said you got to tear that building down and build it again so that it basically won't slow down traffic. I'm kind of oversimplifying it, but they have to tear that old Raising Cane building down off of all that real estate they bought. I mean, it's not that much, but off that real estate they bought, that good building, which I think is silly, they got to tear it down to help control traffic. That's the easy part. And when you drive up down the street, you want to stay behind. So I do understand that, but it's a very nice building. I mean, they had to move out of here, right? What does that go with now? does that go with the building or does that go with the cost of land?
Demoliting the building,
Yeah, that building that's on that land.
that would go with demolition costs.
That's true. Now, will demolition costs go under this category or will it go under this category?
Land,
It'll go under land. Why is that?
because they're not doing anything to help improve the building or do anything for the building.
That's very true, and it is nothing wrong with that. I'm going to add on to that only for accounting purposes, But what you're saying, I mean, if you think like that, you got the right answer, and you cannot go wrong with that thought. I'm just going to add something else to it, okay? All that stuff. Say it again. What you said. 'Cause I like what you said. Say the first part you said again.
The demolition, it doesn't do anything to improve or help the building.
Right. It doesn't do anything to improve or help the building, but it does something to improve or help the land get ready for its, here's the key word, intended use. It's getting ready for its intended use. It has nothing to do with the building. Great building. They're going to buy another one. But it's getting the land ready for its intended use. So for that reason, this is going to go, obviously, to land. I'm just kind of rewriting it again here. We know all this goes to land. And this goes to land, okay? Now, are we clear? This goes to land because it is getting the land ready for its intended use. We're good with that, right? Right? Now, think about Facebook Marketplace, right? And you always see they got something out there. And I like to, old bricks, old concrete and stuff from something they tore down, right? And so they're selling it. Take that same thing, that same concept, and understand that somebody can use some of that. That's a good building over there. Somebody can use some of that stuff, right? So if they paid $10 for this demolition, it paid $10 for the demolition, and they were able to sell some of their supplies for $2. Understand that what they get back is going to decrease the demolition cost that they have, okay? You got that? So if that building, if they paid $50,000 to get that building knocked down, but they were able to sell some of the things, some of those bricks and some of that good stuff for $7,000, then that would decrease the demolition cost. Why? Because think of it as offsetting, okay? You paid $50,000, you're able to sell some of it, and so you only were out of pocket of $43,000. Does that make sense in terms of that? And think about that in terms of when you're looking for something that you're looking for, and you see that big old pile of bricks or whatever that looks crazy, somebody has probably already done something, and if they were a business, then they would have to reduce their demolition cost by that amount, okay? So that's just to kind of make sure we understand that concept. Now, we are going to put a driveway, a parking lot, and we've got to have some lights too, right? So how's this going to work? How is this going to affect everything? Is this going to affect the building? Raise your hand. Is it going to affect the land? Raise your hand. Is it going to affect neither one? Raise your hand. I put mine down, so I'm right. Right? There's another category. I told you I'm going to put one more category up here. These things called the driveway, parking lot, all those lights. This goes under something that we call land improvements, okay? Land improvements. Land improvements. So the parking lot, the lights that are associated, I don't care if you have the same lights on your building. When they're part of that parking lot, that's land improvements. You're improving the land, okay? So conceptually, without any numbers up here, do we see where we are at this point in time? Okay? Now, going back to why it's important. We are using this to operate our business, right? This is what we're doing it for. And we want to be able to write some of this off, that's what we're basically doing, as we go. And to do that, we want to write off a portion of that by allocating it and using an account called depreciation expense. So this is why it's important that we properly classify that. Why? Because we said last time, land, you never depreciate land. You never allocate a cost to that land over time. Once again, we're not focusing on value, we're focusing on the fact, what can we allocate? Allocation is depreciation, or the allocation of something, in this case, is depreciation. So anything over here, we cannot depreciate it. I'll put the demolition cost in a second. We cannot depreciate this over here, okay? But since it's associated with the building, we can depreciate that as soon as that's ready to go, right? These improvements to the land improvements, those can be depreciated, okay? You cannot depreciate anything over here. Everybody clear with that? That's the reason we're doing it, okay? Obviously to keep up with stuff, but then we keep up with what we can depreciate. Now, demolition costs, I'm going to put two numbers here because I want to make sure we understand what's going on. We have $8,200 of depreciation costs minus what we got back for our sales. So I put that there so we can make sure that we remember. This is what the demolition cost was, and the other part is, and I purposely didn't put it there, but I want to put it there now. Let me move this out the way. Less salvage. Less the salvage cost, okay? That's what you got back for selling everything. And of course, these numbers here, they would be 9,100 for this example, and that way, if you want to go back and recompute it. And the way I'll show you how you can do that on your own there. You can just write these here and jumble up the order, and you can have those, and you can always come back and check out everything. And this number here should be $93,600, okay? You cannot depreciate land. You can depreciate your parking lot and your eventual building. That's going to be all the cost of your building, okay? Yes, ma'am.
Just the land is the cost of what's in that box, or is that for the building and land?
Oh, that's all of this right here.
So just land?
Just land. And just land cannot be depreciated, okay? I want to make sure we understand that you cannot depreciate this over here, okay? Now, this parking lot costs $14,200. This is going to combine with the discussion we just had on just a second ago on depreciation, okay? This parking lot costs $14,200. Everybody good with that? Now, we know that they only last for a certain amount of time, so we're going to call it the life. At the end of life of this parking lot here, we know that it's going to be worth $4,200, okay? At the end of the life of this parking lot and all this stuff is going to be worth $4,200. We built the parking lot today. At the end of the life of the parking lot, it's going to be $4,200. Everybody okay with that? Now, we can depreciate it for 5 years. We can depreciate this for 5 years. This is my question. How much of this can I depreciate over 5 years?
The entirety of it?
That's what we would think. That's what we would think. We would think it's what it is. But go back to where we just talked about less the salvage value. Now, I don't know if they're going to sell this. I don't know how this was determined. Obviously, there's some computation that go into what's determined. They may know that someone's going to come and use it. You may know that when you finish driving that truck, that you're going to sell it at a certain amount of time, for a certain amount of money. But at the end of life, this parking lot will be worth $4,200. We can only depreciate, allocate. We can only allocate the cost of what we're going to use, right? So we cannot allocate or depreciate below $14,200. So to make sure that we understand, I'm going to erase this because I'm going to use this color again. Our depreciation is always, it can never go below this amount that we call the salvage value. Okay? It can never go below salvage value. So, depreciation is going to be your cost. In this case, out of all the stuff we had, we could not allocate, we could not depreciate this right here. We can depreciate the $14,200. That would probably include, if we talk about our vehicle the other day, that would include everything with that cost in your vehicle that you had, okay? But you have to subtract out, minus, less. You have to subtract out the salvage value. You can never go below salvage value. You can never go below salvage value. So you take your cost, right? $14,200. How much will it be worth at the end of the time? $4,200, right? So in this case, we have $14,200 minus $4,200. That leaves us with how much that we can depreciate? $10,000. And that's what we refer to sometimes as a depreciable cost. So the depreciable cost is $10,000. And that's what we can divide it by over time, which in this case we'll use 5 years. This kind of coming where we're using 5 years. If it's 5 years, it's 5 years. And that will give you $2,000 a year. If it was $10,000, it give you $1,000 a year, and so on. So this is why we have to get our cost right. Because if we don't get our cost right, our depreciation is going to be off. We cannot forget to subtract the salvage value. Because if the salvage value is not subtracted, then you will be putting more expenses in your books, and that may cause you to get audited. And we don't, I mean, you know it's an accident. Who really wants to go through an audit, right? So we want to make sure that we do not go below this in terms of our depreciation. So our depreciable cost, always get your cost right. Find out if there is some value to its salvage value later on, and that is the amount that you can allocate, depreciate to your income statement. Yes, ma'am.
Since the architecture fee is a fee and not, you're having the architectures for forever, that doesn't get any of the salvage value?
No, but why? And here's the reason why. This here, I'm going to erase it. I don't have another color, so I'm about to use the same one here. This here, I'm going to spin up on the right there. This has to do with our building.
Oh, we're talking about later.
And that's okay, because see, the way it's all given sometimes, it can be confusing. So when we talk about depreciating that building, I'm just throwing out a number. That building may be over 25, 40, 30 years. I don't know. This will be depreciated with the building, not with the land, but with the building. So that's why this cost has to go with whatever else it takes to get that building. But as you brilliantly said earlier, the land, this has nothing, the land improvements have nothing to do with the actual land, but it's its own thing that can be depreciated. And the demolition costs have nothing to do with it, except for it is getting the land ready for its intended use, okay? So this gets it ready for its intended use. This is associated with the building, okay? You may have another type of engineer, you may have two different types of engineers, one talking about the building, one talking about the land, depending on how that's classified. But in terms of the architect fees, we know that's associated with the building right there. So that gets depreciated with the building. It's going to have its own salvage value. Okay, so this is what we have, and you can combine this here, since we had it all together, with both of those examples, and that should cover everything that we'll have in terms of definitely for exams, but hopefully as we get out of here, because we want to be able to use it as well. Okay, everybody okay? What are we going to have Monday?